Now, as we look into the U.S. and what is happening within our data sets, we always like to start off with obviously the summary page. So when you look at the current, the demand was at 14.874 million barrels a day. Last week was just below 15 at 14.994 million. So the average is sitting right at that 14.94, which is that white line right there, which is just below that 2019 average. Now, when you look at where we are, obviously for 2020, things became a bit more of a problem as we were going forward. And then when you look at where things are starting out, we expect this to continue to come a bit closer to where we were in 2020 and 2017, which is about that 14.5 million. And that's going to be on the back of obviously that slowdown in heating oil because there's that seasonality. And then we do have some of that offsetting increase in gasoline demand. That's the one that we think that's just going to be a little bit below normal as the distillate goes from being very much above normal and a bit lower into that kind of balancing act. And we'll go through the different pieces on why we think that's the case as jet fuel continues to be a bit below normal, but again, is going to increase along the lines that we normally see for that increase in March. And you can see just where that pivot normally happens. Look at 2020, 2019, 2018, 2017. You can see March is when you start to see those increases. And again, that's obviously with that spring break, which is when you start to see those increases go up. And then you kind of go steady state, and then obviously you move into summer driving season. So that we will get a seasonal bump. That's not something that's going to be out of question, because their seasonality still exists. It's just the seasonality is going to be just slightly below what is normal, but again, still moving in that upward trajectory. So then when you look at distillate had a total draw of 1.55 million. That's something that is going to continue to draw down. But again, the rate of change is going to be, we're pretty much holding out specific, almost exactly to that 29-year average. We're 30.5 million below the 5-year average. And if you look at pad 3 had that drop of 2.24 million, which again comes back to the big drop in run rates, which is where we had some of that big draw. But pad 1 is the important one. So pad 1 had a build of 1.03 million. And that's something where we do expect to see pad 3 continuing to see those increases as we have a bit more imports coming in, and a lot of them are from Russia. So just consider that. We talk about Urals, but we also have refined products coming from Russia. So you can see we're 167,000 barrels a day over the 5-year average on the import side, even though we came down by 4,000 barrels a day. As we've been saying, we're going to stay elevated on the import side. We're still the best market for it. We're still the best for what's coming through. And that's something that's going to continue to move into the system. So then when we look on the production of distillate actually came down by about 27 basis points to just below 30%. And then gasoline actually had a bit of an increase on the yield side, even though total gasoline production came down. It started to get a bit more of the yield component. So again, those are going to be some of the shifts that we're going to look at. Obviously, total run rates in general are down, so just the amount of product coming out will be less, and that's going to again pull down some of that additional capacity from refiners. Now, when we shift to product demanded, as we said, we expected it to go a bit sideways, still remain above the 5-year average. We don't expect to touch it actually, but we do expect it to come down a bit more. We will have a little bit of a slowdown on the trucking side, nothing crazy, but diesel prices are insane. And it's just, we'll go through prices in a minute, but just give you an idea of just where some of the pressure points are. And we will start to see some of that decline in heating oil. And it's always going to be weather related. What is weather doing? How are things going? How are heating degree days, demand days? And those are going to be some of the big shifts. And we do expect to see some of that come down based on where we're going to get some of that warmth coming up. So then when we look at trucking, again, still remaining above that 150 level, as we've been saying, which is going to kind of waffle back and forth. We could get one more step down before we have an increase, but again, just staying very elevated. This is looking back through 2014. So zooming out, even if we have a decline, it's still record levels. It's just we're not going to get back to the record that we saw previously, but just remaining at this elevated piece. So then when you look at load availability, coming down a bit, still a lot of loading out there, and then rates continue to be firm, just given where labor is and where diesel prices are. We don't see that shifting anytime soon. So now when we look at rail traffic, you can see that there was a big swing higher. Total car loads are now 11.9% above 2021. February had a big dip. And that's something that we're starting to see that now. The comps got to get a bit easier. They get harder again. But there's going to be a certain amount of back and forth. But you can see coal is going to stay strong. We don't see that shifting. Again, grain, forest products, all going to stay strong. Motor vehicle and parts, we're starting to get that turn back up just because there was a huge problem at the beginning of last year that remained elevated. So that will stay higher. And then intermodal had a nice catch up. Now, some of the quotes that I'm going to use are from the CAS index, just based on what they see so far. And I think they do a really good job of kind of highlighting, especially on not only just the rail side, but also the trucking side. So with significant negative effects on transportation capacity, Omicron has added to inflationary pressures. But obviously, we've had some of that strength on the employment side. So as the railroads continue to struggle with excess miles in the freight network are persisting, which also adds to these costs. Chassis production has improved considerably for the past 6 months, but only enough to turn the direction of the chassis fleet from contraction to slight growth. And the chassis fleet remains far from what is needed to address the rail network congestion issues. The tight intermodal offtake capacity continues to slow the network and press freight into the truckload market, particularly off the West Coast, raising the truckload length of haul and the LOH by 20% year on year. In January, trucking continues to take share from a challenged rail network, with intermodal volumes at risk of 2 straight quarters of double-digit year-over-year declines in Q4 of 21 and Q1 of 2022. So again, a lot of the same issues that we've been highlighting continue to persist, which is keeping stuff off of rail, keeping it on a truck, which increases cost, increases just the congestion that remains, and we just don't see that abating anytime soon. And we do agree with the analysis that this goes well into well through Q1 and really into Q2 as well. Now, when you look at what's happening on the coast, still a lot of coastal issues in terms of the amount of ships available, the amount of ships waiting to offload. This is going to keep things, again, a bit congested as we go through the remainder of the year. We don't see this adjusting anytime soon for the better, but just to give you an idea of kind of where things sit at the moment. Now, when we look at outlooks, for those that are in the Northeast, you were outside. We went from 22 degrees, anywhere from 12 to 22 degrees. Now we're going to be in the mid 50s. So again, you're getting some of that warmth that's going to reduce the amount of heating oil that's going to be consumed, natural gas, propane. But at the same time, you're going to have the other half of the country that's going to see some additional cold weather. So depending on what is consumed in that area, this should keep natural gas fairly balanced in terms of consumption. But heating oil, with a large part of heating oil being in the Northeast and obviously parts in the North, that's going to bring some of that down. We'll still have diesel demand, but this should alleviate some near-term tightness when you're thinking about heating oil, especially when we're considering Pad 1, which is where the biggest shortfall it currently is in the market. So then when we look at gasoline had a drop of 1.33 million. That's 9.7 million below the 5-year average. And you can see that it was driven by Pad 1, which had the drop of 1.74 million barrels. And again, that's just based on refining coming down so much. And depending on where, we're still following something pretty similar to that 29-year average. We were expecting it to go a little bit higher. I underestimated the amount of refining capacity that was going to come down. That the 685,000 was a bit of a surprise. I thought it was going to be about 200,000 based on what had already been through the system. But clearly, again, I was wrong. But then on the other side, when you look at gasoline, that means that as these guys come back, they're going to be coming back a little little bit later than normal, which is going to, again, put us really right where we see that you see where that dip is coming into March, March 17th, when you see that drop down. That's going to make the comps a little bit easier when we're looking at flows on gasoline stocks. Now, imports remained right around normal. 41. We had an increase of 41,000 barrels a day. That puts us just positive 3,000 barrels a day above the 5-year average. Again, something very stable, nothing too crazy on that front. And we don't see that shifting. As we've been saying, we expect the 5-year average to kind of stay right within a very tight range of the 5-year average. Now, U.S. weekly imports of European gasoline declined to a 4-week low. We brought in 113,000 barrels a day, which compares to 152,000 barrels a day. That's going to see a bit more pressure, especially as Europe is going to be incentivized to send it into Nigeria or other parts of Africa. So on that, we could see imports dip a little bit. But again, we're also not exporting our gasoline to any real growth. So there's going to be a certain balancing act in that approach. So U.S. Atlantic Coast also received 2 European ultra-low sulfur diesel cargoes, totaling 957,000 barrels a day. That's also going to remain elevated on the ultra-low sulfur diesel front. Now, when we look at congestion, you can see that we're starting to get that bounce in China. China is going to continue to see an increase. And then when we look abroad, when you look at the Google Mobility Index, the Americas, Europe, starting to come back up. That's going to continue to increase along not only just, as people kind of awaken from Omicron, but also as people prepare for April driving, for winter and spring break. But you can still see how much distance we have to cover. And as we were saying before with Asia Pacific never came down to the same level like where a lot of the emerging markets are. So that's something that, again, it's just going to go flat at this point and will start to curl back up. But that's where we see a lot of these things really converging and staying about 10% below normal, which is what we've been discussing for the last few weeks. Then you look at Apple Mobility, Europe is starting to come back up. Germany's lifting restrictions, other restrictions are being lifted. And that's something that you're also seeing in Google Mobility. It's just, I think that's giving you a better picture of where things are in general. Now, when we look at the U.S., U.S. gasoline demand fell 3.7% from the prior week, and increased about 2% from the prior week, and was about 1.4% above the rolling 4 weeks. Again, it's just staying kind of within this fairly tight range, and that's something that we think is going to just persist as we go through the remainder of this slow period. And then as we come into March, we expect this to continue to go up as people drive a bit more for spring break, but there's going to be some headwinds with that, i.e. price. So when we look at where gasoline prices are, you can see that there was an increase in price by over 4 cents. We're now at 3.487, so we're approaching $3.50 as the seasonal average, the national average, which again is going to become a bigger problem overall. And that's something that we want to look at when we're considering what is the consumer going to do, because when we look at retail sales, obviously retail sales were higher, but that's a nominal number. So it's going to come down to what is value versus volume. And we're starting to see some of these pressure points, and diesel prices aren't helping, as we had over a 6 cents, almost a 7 cent increase in pricing. And we're at 4.019. So we're over $4 on the national average, which is, again, putting pressure on heating oil, which is mostly diesel at this point. And then obviously road diesel, and all of this is a straight pass-through, which is why we continue to see pressure points on shipping, on just cost in general, which again, everything is shipped. I mean, there is not a single thing that you touch that isn't shipped. So again, all of this gets baked into those prices, which is why we'll continue to see those pressure points. And if the companies don't pass it through, well, then that means that they're eating that cost, which then obviously decreases their margins. Now, as we go into the blending components, you can see that we're right around normal in terms of where some of those numbers are. So just to look at what the drop down was, we had a decline of 340,000 barrels a day. I'm sorry, 340,000 barrels out of storage, which is just 1.4 million below the 5-year average. But you can see just how it's in that congestion point. We expect that to go sideways and stay elevated, just given where petchem demand is fairly low. And that's something that some of these blending components could go into. It could become octane, or it can become petchem feedstock. So that's where, when you look at gasoline having a drop of 1.33 million, but then blending components a drop of only 340,000, you get an idea of kind of where some of those shifts are, and just where we will see, again, a draw, most likely, given where PADD 3 sits, but just a fairly stable kind of number in terms of where we are, just a gradual drop down versus kind of this big drop on storage, on the storage front. And it's all just, again, looking at what is happening with the blending components and what do we expect to come from that point. Now, when we look at demand, you can see that demand had that drop. We're now just above where we were in 2017, but we're below, again, 2020, 2019, 2018, 2016. So we're just right in this, just below that normal level. And again, we will start to see these increases. And look, and every year you have an increase that really starts next week, which is when my kids have their winter break. So again, that's where you start to see those increases, and then you see that steady state and then kind of flatlining as we go through spring, and then you get into key driving season. So again, we're gonna follow that trajectory. It's just going to be at a slightly reduced rate, given flexible schedules and all these other components that we continue to talk about in the econ show. Now, when we look at the U.S., you can see things are starting to peak back up. That will continue, especially on the park front, because things will get a bit warmer. You can see transit stations picking back up, workplaces back to the highs, and now that's something that we do think levels off, just given, again, that mix between flexible schedule, work from home, and those that will be back in the office. But we should see another spike as we get into March, because that is when some places are requiring people to come back to the workforce, back to in person. Apple mobility trends, another nice increase, but again, just something very similar from what we've seen, of just more of a kind of that steady increase, which will accelerate as we go through March into April. Now, propane continues to be at a concerning spot. You can see that we had a draw of 5.94 million. That's 11.7 million below the 5-year average. And now it's just outside where we were for 2018. So again, you're starting to see that concern as demand remains robust in the U.S., even as we have some slowdowns in exports, but we did obviously have a big increase in exports this week. And this is where we have the biggest concern, which is the decline in days of supply. Remember, 20 is a very important number. So the fact that we're getting a little bit of a warm up should reduce some of the amount of propane that's going to be consumed, and continue to kind of flatten that out. But weather is going to be a big driver of how concerned are we going to get, and where is pricing going to go. On the jet fuel side, we had a drop of 670,000 barrels. That's keeping us, at about 5 million below the 5-year average. And you can see that we're just kind of now waffling, coming to that point that we've been discussing of between that 1.4 and 1.5 million barrel demand level. And now, as we go through the next 3 weeks, next week should be fairly flattish. And then as we get into the second week, we'll shift that up to about a 1.45 to about a 1.55 million demand level, just given that you're going to have some of that jet fuel being consumed ahead of, and making sure that it's available for the increase in departures that we expect as we go through March, but really getting into that April period. Now, when in terms of what we're talking about here, you can see that we're starting to see those increases along those seasonal norms. We saw it in 2021. You see it in 2019. And that's something that's just going to continue. It's just going to be at that reduced rate, just given where prices are and where the availability of seats comes in. Now, one of the things on a global level, the passenger flight schedule for the 12 weeks ahead is 0.7% lower week on week. That's actually the lowest decline that we've seen. And on some metrics, we're actually now going positive. So it just means that we're starting to get towards the end of the departures, the declines. We're starting to see some of the airlines now normalizing where their departures will be. And we should start to see some of those increases as they prepare for, obviously, that summer vacation. Now, on the open table side, I'm not really sure what February 14th was, to be honest with you. So I'm just going to say that that was a big number for reasons that I may not understand. I don't know if the comps were harder, but just going back through that period, you can see that as we look at the weekdays were typically 15 to 20% below normal. Weekends were about, let's call it 0% to 5% to just 5% below normal, and that's something that we think is going to persist as we go through the remainder of the quarter and then start to get better. And we could actually see a little bit of a surprise to the upside as things warm up and people start eating outside again. And again, that would be beneficial. We should see some bigger increases in Europe as some of the restrictions continue to be lifted, and that will again drive that number a bit higher. Now, in the next segment, we're going to look abroad and talk a bit more globally, but also really internationally on what is happening and where do we think differentials are going to go, and some of the potential pressure points that we see and or opportunities we see as we go through the remainder of the quarter.